One of the costliest mistakes that investors make is to think they are investing while they are actually speculating. To avoid this costly mistake, we are going to do two things in this video. One, understand clearly the difference between investing and speculation. And two, use that understanding to make sense of the answers to the 6 questions in the following quiz. Let's start with a rapid fire quiz on investing. Are you ready? Let's go. Buying an IPO stock, is it investing or speculation? Speculation. Buying gold? Speculation. What about farmland? Investing. How about cryptos? Speculation. Buying stocks of profitable companies with a track record of growth? Investing. Last one. Buying options? Speculation. If you found some of these answers surprising, then you're not alone. Welcome to A Game of Money, where we learn how to make better decisions in investing, business, and careers. This video is the first in a 5-part series that I'm making to help beginners get started in investing through simple steps, and hence I'm calling this series the Start Investing series. The principles covered in this series would apply not just to stock market investing but also for investments in other assets such as real estate, cryptos, bonds, mutual funds, etc. At the end of this 5-part series, you will have a clear understanding of what is investing, why you need to invest, what are the different investment options available to us, what are the do's and don'ts for investors, and I will also show you how you can open an online brokerage account and make your first investment trade. So be sure to watch the full series. This video's focus is to understand what investing is and how it is different from speculation. Both investing and speculation can be part of an overall healthy investing strategy, and it need not always be one at the exclusion of the other. While speculating, you would have to be clued up on the market, be nimble, and take profits. But while investing, you might want to ignore the market and stay invested for the long term to see if you can make the big money. This difference in approach would help avoid the costly mistakes typically made by mixing up investing and speculation. But to do that consistently and without confusion, you should first be able to answer the question, what is investing? Let's start with the book that is considered the Bible of investing, The Intelligent Investor, and see what Ben Graham has to say about investing in this book. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. There are 3 ideas that stand out in this definition. 1. Safety of principal. 2. Adequate return, which can be 6 to 8% return after adjusting for inflation. And 3. Thorough analysis, which involves going through all the information accessible to you and then making an informed decision on the investment. While this definition is good, it still looks at investing purely from a risk and return perspective and says nothing about the nature of the asset we are investing in. So to complement this definition, let's look at what Warren Buffett says about investing. He says that an investment is a productive asset in the sense that it can produce an income and therefore has value regardless of whether there is an organized public market for trading it or not. So buying a farmland is an investment as it generates income, and a stock is an investment as well as it produces a dividend. Great. Now we have a 2-point definition, and let's put this combined definition to test. If you buy a stock of an established and growing company, let's say Apple, for a certain price with a long-term outlook of 5 to 10 years, and I buy stock in Apple at the same time, but to capitalize on an anticipated short-term price bump due to a new product launch, then by our definition so far, both should be investments, isn't it? But notice that I don't have an intention to capture the dividend income stream or the growth that accrues over the years, and I'm merely focused on the short-term price movement of Apple shares. So what I'm doing is actually speculation, even though Apple shares themselves are investment worthy. This is an important distinction to keep in mind. So to make our definition watertight, let's go ahead and add the long-term rider to our definition. But then how many years can be considered long-term? Some say 3 years, some say 5, and some say long-term is forever, meaning you just keep collecting the dividends. But for me, the purpose of investing long-term is to cancel out the price-related volatility and seasonality so that the true value of the company, which is determined by growth and the future earnings potential of the company, are reflected in the stock price. And for that to happen, you should invest at least for a time period which is equal to 1 market cycle, which is nothing but the length of the bull market and the bear market put together. But it's hard to predict the length of a market cycle as every time it's going to be different and average lengths are not of any practical value. So I'll just leave you with the logic and suggest that you make your own best judgment as to how long is long term based on the type of market you're investing into, such as stocks, real estate, etc. So that's it. We have our own custom definition of investing, and whenever our activity doesn't meet this criteria, it is speculation. Or in other words, when there is an undue risk, or the asset is not a productive asset, or when the time frame of our investment operation is short, it is speculation. We have created our definition by borrowing pieces of it from all the wise people out there, and let's put it to test right away with some warm-up exercises. If you like the video so far, please smash the like button. This will be helpful to me as I'll get to know that this is the type of content that I'll need to make more of. While discussing the definition for investing, we already saw that farmlands and stocks of profitable companies which have a track record of growth are typically treated as investments as they are capable of producing income streams. But even these become speculative when we trade in them based on short-term price movements. Now let's look at the other 4 assets which were included in the teaser at the beginning of the video and understand why they are speculative by their very nature. IPO stocks. A company doing an IPO is typically yet to be profitable, and that itself is sufficient to rule it as speculative as it doesn't meet the principal safety requirement as per our definition. Secondly, most of these are growth companies which have a limited financial track record. And of these limited number of years in existence, they only release financial statements for a subset of those years, typically 2 or 3 years. This makes the information less complete and risky. Lastly, the Securities Exchange Commission, or the SEC, which is the regulating body of capital markets in the US, itself rules IPOs as risky and speculative in the IPO Investor Bulletin. So it's safe to say that IPO stocks are risky and speculative. Now, coming to gold. Gold is a speculative asset because it doesn't produce any income and relies purely on price appreciation to produce any value. Some will argue that gold has intrinsic value and it acts as a store of value, etc. But that argument doesn't hold up, as the value being referred to here is actually derived based on the economic principle of scarcity and not based on its income producing capability. Understanding this is very important because then it'll allow you to think in the right terms and use gold as an inflation hedge and for its speculative value rather than as an investment. And that will give you the best returns with gold. Cryptos. For cryptos, we can make an argument which is very similar to gold as to why it is speculative. Moreover, they are less proven than gold and more price volatile than gold. Lastly, options. Options are hedging instruments which are typically used to reduce risk in an investment or a business portfolio. But the way it is used now, let me explain by using an analogy. What was meant to be taken as a dessert at the end of the meal is being consumed as the main course of the meal by some people. Needless to say, it is not healthy. Options do have speculative value, but you need to have specialized knowledge in order to profit from using options, and clearly it is not for beginners. With those examples, I hope it became clear to you that IPOs, cryptos, and gold, which are typically praised as investments by the popular media, are actually speculative in nature. On the other hand, most types of bonds, low-risk mutual funds, index funds, stocks of profitable companies with a track record of growth, and real estate can be treated as investments, with the catch that even they become speculative when you trade in them for the short term purely based on price volatility. Here's the final takeaway from this video. While investing and speculation need totally different approaches and mindsets, our overall investment strategy could still include both of them, with the mix being determined by our risk tolerance. But for beginners, investing is the best place to start. Here's a trick question to test your understanding. Let's say you borrow money from a friend and invest in Apple shares for the long term. Is it investing or speculation? Let me know in the comment section below. If you like the video so far, please give it a thumbs up and consider subscribing to the channel, and also hit the bell icon next to it so that you can be notified whenever I post a new video. In the next video, we'll discuss the all-important question of why we need to invest. If you'd like to check out the other videos in the series, please click the playlist here, and I'll be populating the playlist as and when I make these subsequent videos. See you again.